The International Monetary Fund's latest World Economic Outlook projects a global economy that appears to be managing its current geopolitical stress. On the surface, the numbers suggest a moderate, manageable slowdown. The headline baseline forecast puts global year-over-year growth for 2026 at a sluggish but stable 3.1%. But that specific projection relies on a highly optimistic input variable, an early end to Middle Eastern conflicts, and a global crude oil price averaging just above $80 a barrel. The reality on the ground is rapidly diverging from that model. With Brent crude already settling near $99 a barrel, the baseline model is breaking. This chart plots IMF growth models against energy costs. The top line traces the stable 3.1% baseline tied to $80 oil. We're rapidly approaching the severe scenario, where crude pushes past $110 to $125, plummeting global growth to a recessionary 2%. That headline projection of a moderate slowdown is a statistical mirage. Corporate finance leaders must immediately recalibrate their macroeconomic models for a severe downside trajectory. The root cause of this data discrepancy is an ongoing, severe exogenous supply shock. The continued closure of the Strait of Hormuz has created a physical bottleneck, embedding a permanent risk premium into global energy systems. Over the past decade, we operated in a synchronized, globally aligned macroeconomic environment. This single external variable is fracturing that alignment. Nations have vastly different dependencies on imported energy. Because of this, the shock is forcing the world's major central banks onto completely opposite trajectories. Domestic economic strength is no longer the primary driver of policy. Proximity to independent energy supply now dictates a central bank's survival. Look at the United States. Thanks to its structural energy advantages, the Federal Reserve is adopting a strict higher-for-longer monetary stance. Internal Fed projections note that sustained high oil prices will lock underlying inflation nearly a full percentage point above the standard 2% target. Consequently, modeled rate cuts are facing massive delays. U.S. interest rates will stay well above the projected 3.1% target through 2027. The Eurozone, lacking that domestic energy resilience, faces a completely different reality. Europe is trapped in acute stagflation. The European Central Bank will be forced to execute a 50 basis point interest rate hike simply to fight off imported inflationary pressures, despite a weakening economy. Japan is even more exposed to the cost of imported energy. To defend against this imported inflation, the Bank of Japan is desperately attempting to normalize policy. They are actively abandoning their zero-interest framework and aggressively hiking toward a 1.5% neutral rate. This divergence map tracks the three resulting yield curves. The U.S. curve remains elevated and flat. The Eurozone curve spikes sharply, despite lagging growth, and Japan's curve steadily lifts off the zero bound. This monetary divergence sets a dangerous trap for governments attempting to shield their citizens from the immediate pain of inflation. This brings us to the most critical takeaway from the IMF report, a harsh condemnation of how governments are managing this crisis. Across European nations and Japan, politicians are deploying broad energy price caps and blanket consumer subsidies. This chart illustrates the fundamental economic flaw. An artificial price ceiling distorts natural market adjustments, creating a massive gap between restricted supply and elevated demand. By shielding consumers from true energy costs, governments artificially prop up consumption, preventing the demand destruction necessary to stabilize prices. The IMF is explicitly advising that any fiscal support must be narrowly targeted and require non-negotiable sunset clauses. Political survival is overriding economic prudence. These nations are masking inflation for the consumer today by guaranteeing a massive structural deficit tomorrow. The ultimate consequence of these artificial price caps is what we call the fiscal expansion trap. This system maps the crisis. An energy shock triggers broad consumer subsidies. Governments execute massive deficit borrowing to fund them, while central banks hike rates. This exploding national debt forces bond markets to demand higher premiums. Eventually, unsustainable debt costs force governments to abandon price caps entirely. Consumer energy subsidies do not solve the economic crisis. They simply take an energy inflation problem and mutate it into a devastating sovereign debt crisis. For capital allocators and finance leaders, macroeconomic theory must now translate into corporate strategy. How must your balance sheet be positioned for the second quarter of 2026? Corporate treasurers in Europe and Asia must not build financial models that rely on the continuation of current government energy subsidies. The The threat of sovereign credit downgrades will eventually force governments to trigger those sunset clauses, abruptly yanking the fiscal lifeline. The moment those artificial price caps are removed, corporations will instantly absorb a violent, sudden spike in operating and logistics costs. You must independently lock in long-term energy and freight hedges immediately, modeling your operations under the assumption that the Hormuz premium is a permanent fixture. Corporate survival over the next 18 months depends entirely on preemptively hedging against the failure of government fiscal policy. Institutional investors and portfolio managers navigating this fractured environment face a different set of directives. This strategic allocation matrix cascades the $125 macro shock down to regional policies. Fixed income managers must aggressively underweight European and Japanese government bonds. The mathematical certainty of the fiscal trap guarantees yields will spike, triggering severe price depreciation. Conversely, portfolios should maintain a heavy overweight allocation to U.S. equities. The data confirms a structural U.S. safe haven premium. While Europe and Japan struggle, the S&P 500 has demonstrated immense resilience, recently breaching the historic 7,000-point milestone. Focus specifically on U.S. large-cap technology and AI sectors. These companies possess the pricing power and insulated balance sheets required to completely override a global energy shock. The global economy is fracturing along energy lines. So are blanket energy subsidies a necessary evil to prevent civil unrest, or are they a fatal fiscal trap that will ultimately crush corporate margins when the bill comes due? Let us know your strategy in the comments.